Hey, welcome back to yet another video, guys. If you want to learn about currency correlation and commodity correlation and just understand currency correlations within the markets in general, you may want to stick around with this video. So make sure you crank up the volume, put some headphones in, lock in and write down some notes as well. So currency pair correlations is a fundamental aspect of trading, providing valuable insights into the relationship between different currency pairs. By analyzing these correlations, we as traders, we can diversify our portfolios, we can manage our risk a bit more effectively, and we can identify potential trading opportunities, and also we can avoid unnecessary losses, and also it could even give us the ability to stack to our winners, okay? And also another little single final one is it also adds confidence to our positions. I'll explain a little bit more about that later. Currency pair correlations measure the statistical relationship between two currency pairs, indicating how closely their price movements are associated. These correlations can be positive, neutral, or negative, providing valuable information about the interplay between the different currencies in the market. Now, each currency is driven by its own fundamental factors. For example, if we take a look at both New Zealand dollar and Canadian dollar, they are commodity-driven currencies, meaning New Zealand is driven by a strong export of agricultural and dairy product exports, and Canada is heavily involved in oil production and exports, and thus is often positively correlated with the price of crude oil. A trader looking for correlations would be smart to analyze the data and the price movements of both types of commodities in order to determine if there will be a correlation between the two currencies. So understanding currency pair correlations is crucial for forex traders seeking to optimize their trading strategies and maximize profitability. And obviously, by incorporating correlations into your analysis as well, we can, you can gain a deeper understanding of the market dynamics and just make more overall informed trading decisions. So there's different types of correlations. There is positive correlation, negative correlation, and neutral correlation, as we know. So positive correlations occur when the price movements of two currency pairs are positively related, meaning they tend to move in the same direction. So for example, the euro dollar and the pound dollar pairs often exhibit positive correlations as both currencies are positively correlated with the US dollar. Similarly, Aussie dollar, US dollar, and the New Zealand dollar, US dollar, are also closely correlated, with give that both their currency values are directly impacted by the US dollar and the China trade. Positive correlations can be leveraged by traders to identify trends and capitalize on the movements in the markets. And by trading currency pairs with positive correlations, we can amplify our returns and exploit opportunities for potential profit, right? Whereas on the other hand, you've got a negative correlation, which is pretty much just the opposite. So negative correlations occur when price movements of two currency pairs are inversely correlated, meaning they tend to move in opposite directions. For example, you've got the USD JPY and the Euro USD pair, right? Those both may display a negative correlation, as the US dollar and Japanese yen often move in opposite directions. So if you look at also another one is the DXY, which is the US dollar, but that's just a ticker for it on TradingView. And you also take a look at the euro dollar, you will see that they have an inverse correlation, meaning if the DXY is up, then the euro dollar is down, vice versa. If the DXY is down, then the euro dollar is up. Okay. Another example of a negative correlated pair as well is the dollar, so the US dollar, and the Chinese yuan as well. So negative correlations can be utilized by us for hedging purposes, right, and risk management, especially. So by trading currency pairs with obviously negative correlations, we can offset potential losses and obviously diversify our portfolios, I guess, to mitigate risk, essentially, right? Also, on the other hand, you've got neutral correlation as well, which is, well, you've already guessed it. Neutral correlations occur when there is no significant relationship between the price movements of two currency pairs. In this case, the correlation coefficient is close to pretty much zero. There's ratings and numbers, which I'll show you guys a website in a minute, indicating that the price movements of the two currency pairs are independent of each other, right? While neutral correlations may not provide immediate trading opportunities, they are still quite valuable for advanced traders seeking to maybe analyze the market trends and anticipate potential shifts in the market sentiment. Okay. Now, there are numerous factors that can influence the currency pair correlations, ranging from economic data or economic indicators to geopolitical events, right? And understanding these factors is essential for traders seeking to anticipate the market movements and adapt our systems accordingly. So number one is obviously economic indicators. Economic indicators such as GDP growth, inflation rate, interest rate decisions, these can all have a significant impact on currency pair correlations. For example, Positive economic data from the US may strengthen the US dollar and lead to positive correlation between the US dollar pairs. Advanced traders should closely monitor key economic indicators and assess their potential impact on currency pair correlations. So by staying informed about economic developments, us traders can anticipate market trends and position ourselves accordingly. Next up, we have geopolitical events. So geopolitical events such as elections, geopolitical tensions, and trade disputes, these can all influence currency pair correlations. So for instance, uncertainty surrounding the Brexit negotiations, this may lead to increased volatility and negative correlations between the pound pairs. Advanced traders should be vigilant about geopolitical events and their potential impact on the currency pair correlations. So obviously, by again analysing geopolitical events and risks and their implications for the forex market, traders can make more informed trading decisions and mitigate potential trading risks. Now, moving on, we have market sentiment as well. So market sentiment, including investor risk appetite and market volatility, can affect currency pair correlations. During periods of heightened risk aversion, safe haven currencies like the US dollar and Japanese yen, this may strengthen, leading to negative correlations with riskier currencies such as the Australian dollar and the New Zealand dollar. So traders should monitor market sentiment indicators, and assess their impact on currency pair correlations. So by gauging investor sentiment and market dynamics, traders can identify trade opportunities and adjust their systems accordingly as well. So on this website here, this is called MatAF. I've used this for many years and I've recommended it to my students. I'm not paid for it or anything like that. There is a login button there, so I don't even log in. So I wouldn't really recommend logging in because I haven't really done that myself. So I can't testify and say log in, create an account. You don't need to. You can just use the tools without creating an account, right? If we just take a look here, as you can see, going a little bit more about sort of the correlation. Well, this is more so the correlation coefficient. So the correlation coefficient just provides a quantitative measure of the strength and direction of the relationship between two currency pairs, right? So as you can see here, this following table, this represents the correlation between the various parities of the foreign exchange market. The correlation, the coefficient highlights the similarity of the movements between two parities, okay? So two currencies essentially. If the correlation is high, so that means if it's high, that means it's above 80. This means then the currencies move in the same way. And when it says and positive, that just means in the green. So if the correlation is high above 80 and the negative, so that means in the red. So the green is positive, the red is negative. So if the correlation is high and above 80, but it's negative, then the currencies move in the opposite way, okay? If the correlation is low, below 60, then the currencies don't really move in the same way. So if we just take a look here at the pound dollar, and let's just take a look at, and also as well, just before I go more into this, you can click on this here, you can exclude, so you can like remove some as well if you want. You also got these here as well, so you got daily, the 4 hour and hourly, because obviously if you look on different time frames, you'll notice that they all move similar on a certain time frame rather than the other time frame, so to speak, right? So they all sort of essentially move differently according to the time frame that it is, okay? So if we just look at, let's say, I don't know, pound Swiss, and we'll just pick out a random pair, Euro Swiss, right? So the pound Swiss and the Euro Swiss, they have a 92 rating in the green, which means that they both move positive. So you can expect if the Euro Swiss is up, then also the pound Swiss is up, okay? Euro NZD and GBP CAD, they have an 86 rating. So if the Euro NZD and GBP CAD is both moving bullish, well, if one of them is moving bullish, and they're both moving bullish essentially, right? Because they have quite a high, correlation. Remember, guys, these can change as well based on obviously what we've spoken about previously. So just remember that. We just pick out, let's go with CHF JPY, and we'll go over here to Euro AUD. So the Euro Aussie dollar and the Swiss yen, as you can see, they have a minus 90 in the red. So that essentially just means that they move in the opposite way. Okay. Let's go with minus 43 NZD CAD and GPUSD. They don't really move the same way or anything like that. Swiss yen and pound CAD, they move quite opposite. Sorry, that's Euro CAD. They move quite opposite. But I don't need to sit here and show you guys, but you can go ahead and look at this website. Like for example, look at the Aussie dollar yen and the Euro yen. They have a 98 rating, so they move almost alike, so it wouldn't make sense to be shorting the Aussie dollar yen and be buying the euro yen based on that. Okay, so that's one of the big keys or takeaways you can take away from this video. Is just, you know, don't get caught up on the wrong side of the market. Understand the correlation obviously is a big important thing. So, but the main correlation that we use in terms of what we look at on the charts on a daily basis is more so the DXY, which is the US dollar index, and also the euro dollar. So if you look at the euro dollar and the DXY, so if you just pull up the charts and look at the euro dollar and DXY, you'll see that they move in quite a similar fashion. So for example, if the DXY is up, then the EU is down. If the EU is up, then DXY is down. Okay, so if you trade Euro USD, especially because a lot of you will do, because obviously the euro dollar, that is the major currency pair. It's the most traded currency pair around the world. It's got the most volume inside of the pair as well. So it's obviously definitely the most traded pair at this point. So if you trade Euro USD already, but you need a little confidence, just refer to the DXY. As we know, they have a direct inverse correlation, meaning that if the EU goes up, DXY goes down, vice versa, EU down, DXY up. Okay, sometimes when you trade in EU, it may not do that as something that you were anticipating price to do, but if you switch to the DXY chart, it would have done it. So for example, if you're targeting a specific area on the EU, but it just misses it by not much, a lot of the time DXY would have already reached that level. Okay, so you can consider it mitigated. Another example, if you assume price is broken structure, so a CHOC/BOS on EU, sometimes if you switch to the DXY, it might have not broken that level, or might not have chocked or broke structure just yet, which could explain why your EU trade did not work out. Okay, so it's good to trade a DXY just for extra confidence within EU, essentially. Okay, but that's pretty much it for this video, guys. There really isn't much to it. As you know already, there's a lot of currency and commodity correlation. Another commodity correlation as well, I think I've already mentioned this one as well, is but the Canadian dollar. This has a high correlation with the crude oil, just due to a significant proportion of Canada's GDP relying on oil. Also, while historically AUD has a strong relationship with gold, GBP currently has the highest correlation at 0.55 with gold as well. Just keep that in mind, because Aussie dollar used to have a very high correlation with gold, but at the minute it is obviously with the GBP. There is also stock correlations as well. So stocks and currencies aren't, you know, known to move in tandem with each other, but Australian dollar has close to a plus 0.5 correlation with the SP 500. So if you just take a look at the Aussie dollar and look at the SP 500, you see that they have a pretty similar correlation. Also, the currency's correlation with the FXI, which is Chinese large cap stocks, is even higher given their geographic proximity and AUD's liquidity compared to the CNH, right? But yeah, you can go ahead and Google like different types of correlations out there and look a bit more in depth into them. But at least from this video, I wanted you guys to understand what is correlation and what can affect it, why it can change, etc. And also give you guys some examples on a website that you can go ahead and look at the different pairs as well. And also, I've already spoken about, you know, some of the pairs that obviously are, you know, positive or inversely correlated. So guys, thank you so much for watching. Check out my mentorship if you haven't. I currently running a discount as well. Use code masterclass and checkout, and you'll get yourself up to £200 off your order. So guys, go ahead and check that out. Take care, guys.